Once again, welcome everyone to now what is the 41st edition of SaaS Talks. As you know, we pick one functional topic every single time, which is more in the spirit of how do you do certain things as you're building a SaaS company. Choose variety of different topics. I'll introduce the topic and the speakers shortly here, but this is meant to be a discussion. It is not just a panel, which means that even the most of you who are appearing as attendees, as you have questions, please do raise your hand or put your question on the Q&A panel. Only request is please do put questions relevant to the topic and not outside the topic. If you have questions on other topics, please do let us know. We'll actually, hopefully in the future episodes, we will select those topics as well. Ritesh and myself. Hi, Rajesh.
Hi, good morning.
Good morning. So Ritesh and I will set the context, ask the first few questions that last about 10 to 15 minutes at best. This is meant to be a participatory sort of forum. So expect rest of it to be driven by the questions that people ask. With that, actually, let me introduce the topic and then the speakers. So today I thought that we'll actually go back right to the beginning point of when you start a company. One of the first things you do is that you figure out who to take your angel capital from, and sometimes even think about how to add advisors to your cap table. And we want to go back to that part of the journey in terms of how do you make the decisions you make, how do you approach all those category of questions we want to cover here today. Couldn't have had two better anchors to join us today. So let me begin with Abhishek first. Abhishek is a twice founder, currently the co-founder and CEO of Tracxn, which I'm sure everybody who is around here has used Tracxn, sees Tracxn all the time. He also has a distinction that he has been an investor before, been an operator as a techie before as well. And I know that he is a very avid angel as well. So Abhishek, welcome and thank you for being here.
Thank you, Alok.
Same actually goes for Rajesh. As most people know, actually I doubt if anybody does not know, but Rajesh is the founder and CEO of GSF Accelerator. We ourselves have been a beneficiary where we have followed on in both Slintel and Botfix after Rajesh has invested in them in the past. Rajesh was the original creator founder of the Times Internet group, from what I recollect, Rajesh. And being a founder, being an investor, Rajesh also founded InnerChef at one point in time, and now is a very, very avid angel. I won't be surprised there are lots of your investee company founders who are on the call today, Rajesh. So again, welcome. Thank you for being here.
Thank you.
Perfect. So we will get started. Ritesh and I will ask the first few questions, and then we will hand it over or leave it to the audience to ask their questions. So given that both of you have both started companies and been angel investors, right? Actually curious, what is the right time, or how do you figure out who are the right angels for your business? And either of you, please feel free to take the question.
So maybe I'll take this one first.
Sure.
So in our case, in the first round, I think so we had two and maybe multiple angel rounds, but there were two prominent angel rounds. One was the first round when we were starting, and we also did an angel round after doing Series A. So in the first round, it was largely driven by people who knew us. It was more to do sort of people who trusted us, so they gave us money. So from an external world is a validation of you as a person, that these are the people who have known you for a while and they feel comfortable enough to give you money. So for external investors, it acts as a validation. And sometimes they can also have a view on your business, and that would be a bonus. We didn't need an advisor come people from industry to do an angel. But that is also a great idea. In the first round, if you get few people who are from the industry and they can somewhat give a validation to your business or idea. So they can give some validation to the market, and largely it's a validation of people. So I would think of from these two perspectives in the first round.
Abhishek and Rajesh, a lot of the founders actually get their first angel checks the way that Abhishek just described, which is people that have known you in the past, and people who have particularly worked with you and seen your performance in previous jobs. But a lot of the founders that start companies are often very young founders who do not have the kind of uh, tenure of employment that you would have enjoyed when you started your first companies. So, how would you recommend that kind of founder? Let's take a 26-year-old founder with 4 or 5 years of experience at most, and necessarily not business experience either. How would you recommend that they discover the right angels to approach?
Yeah, so a great question, Ritesh. So, especially younger founder now, the founders are starting at 18 years old. And many of them are still in colleges and just coming out of colleges, and they don't have, rightly so, the networks, right, on which they can lean on. So some of them depend on their college alumni network, I've seen, to get some validation. But I think there are a lot of forums today where you can reach people, right? Little bit of research can tell you what those forums are, where angels are congregating. And many angels are now open to the idea of, like, I would, in a year, consciously, I would fund 2, 3, 4 startups, very young companies, very risky companies, and I'm looking out for them. I'm seeking them out. I go to colleges. When they reach out to me, I give them time. I'm sure there are many people who have similar mindset. So while it 60-70% of the time, my team and me are busy dealing with deal flows that comes from preferred source, right? A founder in who we've invested previously. So some of the time, the younger founder can go to a founder from their alumni and say, "Can you connect me to Rajesh? Or can you connect me to Abhishek?" Right? So you have to find 3, 4 hacks to get access, and have to be a little resourceful about it, right? So once you get access, then everyone is equal, right? Then it doesn't matter. You spend 20 years in the industry, or you just 1 year old, then playfield is yours. So that's how I see it. I am consciously looking for very young talent with raw ideas. And I definitely will put some money in 2, 3 such ideas, 4 ideas every year. Not all my money behind it, but definitely.
Got it. Got it. Unless Abhishek, you have a different view on the question, please go ahead.
So I don't have a different view, but this is a playbook which I recommend a lot of people. So do your fundraising in 3 stages. First, you take validation from 2, 3 people who have worked with you, who have known you, somewhat build credibility on you as a person. So maybe 2 of your friends or friends' brothers who are doing somewhat well off, you take money from them. Then you approach a micro VC. If you are like very young, 18 to 20, idea is still unproven. So you may not get a $2-3 million check, but you can get a 100K check from a micro VC or a super angel. With that validation, then you go to a broader popular angels or operator founder angels and then get 3-4 of them. So if you were to stretch a 500K round, I would get like 30-40 lakh from my network first, so that when I go to a micro VC, they know that at least 4 people believe in you enough to give you money. So they'll take you more seriously. Then that micro VC can put anywhere between 100K to 300K. And then remaining 100K will probably take introductions from the same lead, so that you go with their conviction, and then get good founder angels who can advise you on the round or in the future in building the company. Potentially also help you in future fundraise. So that will be the playbook that I recommend young people when they come to me.
Got it. Got it.
Abhishek, quite interestingly, I want to share an experience from our own fundraise. Your algorithm triggered this thought. My learning from our fundraise was that one should not optimize for the best check first, but the easiest check first.
Yes.
Because the best check might not even come till there is momentum. But the easiest check is the one that will come without anyone else being on your cap table first. So it resonates very highly with me that the person who's most likely to write a check, you should approach them first, as opposed to the person you most want on your cap table.
I want to add one thought here, Rahul. I think all rounds are built around anchors, right? So it's important to have a thought around, even if it's a 300K round or 3 million round or 30 million round, the anchor is very important. So if it's a smaller round, 100, 300K kind of 500K round, find who's the most credible anchor, right? 50, 100K. 3 million is unlikely angel will be anchor. It will be most likely $1 million check given by a micro VC or someone will be anchor. So put some thought to who will anchor your round. That's the additional sort of lens I want to put on it.
So first of all, I do want the audience now to begin to post their questions. So as I mentioned earlier, between Rajesh and Abhishek, you have two of the most prolific angels in our community on the call. Please do put your questions, and again, please do put them only on the Q&A panel, and also please put it only relevant to the discussion that we are having today. In the meantime, while people are putting their questions, one other question for both of you is that even as we come into companies ourselves, see, there are times when a company has done an angel round and then they raise a VC round, right? And as you look at their angel round cap table, there are those, like I have one company, I'll not name the company, who had actually just 5 angels. And this was an experienced founder. He had a reach. These were relatively larger checks versus those where actually sometimes you find nowadays even 20 to 40 angels on the cap table. So as you have worked with founders, any view on what it does to your cap table between smaller number of angels with larger checks or larger number of angels with smaller checks? What are the implications of the two approaches?
So I feel that if we can get, sorry, Rajesh, please.
No, go ahead.
So I feel that if 40 individuals have said yes to you, there is a good chance that you will find one micro VC to say yes to you. So in those cases, I would prefer to sort of get one person to write like 50, 60% of the round and reduce the number to maybe 10 people. But I am a big believer in keeping enough prospectors on the cap table. Instead of doing just one micro VC and no other people, I would always advise people to keep 5 to 10 people who are founders, operators, who can take advice. You can go and take advice from. The other way to think about this is that if you were planning to give 0.5% to somebody as an advisory equity, instead of that, make them put 20 lakh in the round, then they will work equally hard. And that's a much more efficient way of getting these advisors on the cap table and buying their time.
Fantastic. I was going to come back to that topic, Abhishek, later as well, but
No, I can add a little bit. So you see, I think up to 10 is okay. Nowadays, beyond 10, then it has a long-term impact on, getting EGM clarifications, this, that, so many issues are there. So what I'm seeing founders are doing, they're consolidating smaller checks into one check. And it's possible with the angel fund structures that have come into play now. Earlier, you had to do LLPs and all that. That is not required now. So it's easy. And if there are smaller checks, you see, sometimes founders have network and they get the round constructed very fast, but many founders struggle. And sometimes those companies become very big. So they do need money. So they can consolidate with the help of an angel syndicate structure, the smaller checks into one. It would probably help to keep 3, 4, 5 names directly on the cap table for other media or benefits.
Got it. Ritesh, do you want to pick? We are bombarded with questions on the Q&A panel. If you want to pick one.
Sure. Let me pick a question. There's a question from Atul on platforms, and I've also had that question myself. How relevant are angel platforms, particularly for first-time entrepreneurs who do not have direct networks, would you recommend that they go through platforms or still try to curate the angels themselves?
I think platforms are important increasingly because the government of India is also emphasizing or I think creating regulations in a way that they want most of the money to come through angel funds, right? The whole regulatory infrastructure is being built in that way. So I think I'm just talking for people who have access, no problem, right? Go ahead and raise money from 3, 5, 4, 1 people. But 95% people don't have that, and inevitably they do and need platforms. And I think just you need to be careful what kind of platforms you're going, what kind of what you're giving, right? You shouldn't sign up on terms which are not conducive to next fundraise. Shouldn't do dilute excessive amount of equity for small fundraise. So those things are in your control. But I think platforms are becoming inevitable for large number of startups.
Actually, I have a follow-up question on that, and maybe I can pose that to Abhishek. Do you think that platforms end up, or rounds through platforms end up being party rounds, where there is no real conviction from the angels because it's the platform that is running the deal, as opposed to the angel having independent conviction? And
Yes.
is there a danger then of nobody really supporting the company? And I mean, you get that 1 crore, but you don't really have supportive angels on your cap table.
Right. So I personally am not a big believer of platforms. And it's fair that if you are not in top 10 percentile who have access to these funds, you will end up going to these platforms. But I feel that in many companies, I like this playbook of having one good anchor investors in the round. So if you are raising 1 crore, at least get 50 lakh from a good micro VC who can handhold you, meet you every month, make sure that your numbers are tracking, make sure that you're going in the right direction. This system didn't exist 20 years back. 20 years, there was no investors, there was no VC. So everybody was building companies in silo. Now we have this great framework where there are seasoned people who are advising you on the business, and they're not doing like you're not giving them advisory equity. They're actually putting in money into your business. So I'm a big believer in having that 1 or 2 people who are sort of working closely with you and guiding you on the journey. So if I'm raising 1 crore and if there is an option, I will try to get 30, 40, 50 lakh from a person who is doing investing as a full-time role. And they are people who are going to spend a lot of mind share on your business, guiding you, avoiding common pitfalls. So if there is an option, please always find somebody who has done investing for 5 to 10 years, putting in some amount of money and time mind share for you. This will seriously avoid a lot of basic pitfalls. Platforms do tend to take a lot of fee, and that sort of builds a negative signal in the market saying that you probably could not raise any amount of money. That's why you ended up there. So there's a little bit of signaling risk, but again, if you are not getting a micro VC to lead the round, then go ahead and raise that money because many times good companies have come out of that route also eventually. So it's not a no-no, but try to find a good high quality person to work with you closely. That will be my priority one.
I second it.
Well, 20 years back, none of these existed, right? If you were starting a business, there was no person who was ready to work with you. Like Rajesh can work with you now closely. That didn't exist. People don't realize that.
Absolutely right thought.
That's true. Actually, let's pick a question from Bharat, which is the structure that you should have, which is that, there can be a price round even when you are raising an angel round. And we know that there can be convertible note safes that can be done as well, right? And I know that both of you have sit now on both sides of the table as a founder as well as an angel investor. If you are a founder today, what would you recommend as a preferred structure that they should create in an angel round?
Look, the most preferred founder-friendly structure is YC structure. There's no doubt about it.
Right.
But in India, there is a resistance against it for most people. Most people do tend to prefer a priced round, right? my advice is don't dilute more than 20% in any round, right? Big or small, I generally adhere to this rule of 20%. I advise to founders. If you can do less dilution, 10, 15%, even better. Finally, it adds up to that, right? So that's my view at current point of time. 95% of the deal are still priced. First, second round I'm talking about. Convertible notes are more used in India for bridge rounds. That's what I've seen, where company has raised some round, is a few months or 1 year away from Series A or Series B, and then they're coming to us to take part in those rounds.
Got it. No, absolutely. I'm also on the same page that first round should be 10 to 15% dilutions. If you're doing pure angel, like most 10%, if you're doing a micro VC plus few angels, then maybe max is 15%. And if there is a proper VC, then obviously 20, 22% will be the reasonable dilution in the first rounds. And if you can get a quality person to lead the round, they will price it. So that's great for you. If you can't find somebody, if it's a truly party round, then maybe convertible with a reasonable cap. The cap should again convert to like a 10 to 15% dilution is a good rule of thumb.
So I'd like to move on from the discovery of angels and constructing the round to what happens after the investment. And would love to take up Jay's question here, where he asked for what are the most important non-financial contributions you can expect from angels, and also how can founders best leverage these the angels beyond the capital.
You want me to go?
Yeah, go
Okay.
ahead.
Yes, please.
So I think I have seen in my experience 3 things founders seek from me. Immediately after the raise, some hires, which is first point at which people spend money. So if you have access into the communities of, from tech talent to BD talent, is where I think you can add a lot of value. I remember what fix fortune changed when Wispy was brought on board.
Right.
And he came through our network, right? You remember, Alok,
Absolutely.
right? And what a transformative change it had on the future of that company.
Right.
So that is the first one, I think, where it sort of anchors into. The second is within 6 months, founders are starting to think of next fundraise, planning for it, thinking about the round construct. There, I think we can play a good role to get them to a certain milestone where we think it will work. And so planning for the round itself is more important than just making random connects, right? So that's where I think angels, good angels who helped seen multiple rounds getting constructed from pre-seed to seed or seed to Series A can help. Make the founders realistic about it and choose the right metrics in the next 6 months while they are getting into fundraise mode. And of course, then the networks to help them raise round. And many times, at least in last 2-3 years, we always participate in whatever in the next round, right? So supporting them in the next round by indicating your willingness to participate is also a good signal now, right? So while you're selecting the angels or micro VCC, if they can at least take you for at least for the next follow-on, right? That's a good signal. And the third is, I think, within 6 months, at least in my companies, in 50% of the companies, stress comes. Serious stress in some cases. So stress is product not working, sometimes founder issues, like it's not happening as we thought it should happen. And then they need someone they can talk to, right? Someone who can help them think through, because whether pivot is needed, not needed, it's an execution gap, is a product change, fixes. So many courses have been become available if right advice is given at that point of time, or even to say where to go and get advice on this matter, right? So that is the third place where I play the role. And last is sometime you feel company is not ready for the round, but maybe we should bridge it. Maybe it's still developing product. We've done it in a few times, right? So, okay, you take a little more money, little more time, you keep building, right? These are 5, 6 things that I have seen playing a role. I think Abhishek can add to that. Yeah.
Yeah. No, so I think just after the fundraise, there is usually a discussion on what direction the business should take. What is the bull case of the business? What are the building blocks? What can happen in 1 year or 3 year or 5 year? So there's a lot of strategic conversation on direction of business. With GTM playbook to go after. So there's a lot of debate on that, and that's where I think there's a lot of value, because we have seen many businesses over 15 years, and sometimes there are some parallels that can be drawn. Second is obviously fundraise during the next round, writing introductions, writing warm, strong introductions really help. And I think third, which happens at a much later point of time, is there are things which founders run into which they can't necessarily share with their boards immediately, or things happening on personal front challenges. So they then come to us sometimes and say, "Okay, this is what is happening in my life. What do I do? What's the best way to handle it?" So there are topics which not every time you can discuss everything with your board. So I have seen a lot of queries come to me on that front. But usually my interactions has been largely in these three cases. And again, there is a little bit of distinction between what I do and Rajesh does is I do it as a part-time hobby and Sir does it as a full-time endeavor. So that obviously significantly changes how much and when we spend time with the companies. I obviously can't work with them on trenches because I have like running my own company, which is more than 100% of your mind share, right? So mine is very limited in terms of time spent on these topics, which are much more slightly exception driven than a norm.
Actually, I do want to pick up on that last statement and build on Ritesh's question. Is that to be able to draw the value that that founders seek from you, what is the right engagement model? See, when we come as VCs, we do a monthly call, etc. And of course, in between those monthly calls, there might be many touch points. But what are the right ways for a founder to engage with an angel investor? And in case that is different for the prototype, Abhishek, that you are talking about for yourself versus Rajesh, would actually love to hear those.
Actually, there's probably a lot of difference. I'll cover you my thing. I probably interact. So I invested in delivery. I would have met Sahil maybe 10 times over the course of these 10 years. And all their investors would have met them like 3 to 4 times in a year. So there's a huge distinction between time spent.
Right.
On the operating side, there are largely two bracket of questions where I think I've added up value. One is on the distribution side. People always figure out what distribution to use. There are tons of channels. I think in a lot of cases, the discussions have helped because you have seen a lot of distribution channels. And secondly, direction of the business. There's a D2C brand which I've invested in. Now they're thinking what is the next step for them, what products to launch, focusing more on GTM, focusing more on product like expansion. That is really a good topic for discussion. And again, these are not regular discussions. They come to me mostly on on-demand basis. They feel they have a direction. They would come and discuss that. Maybe initially, as it's twice a year when you talk about business. And it obviously reduces over time when the direction is much more clearer. So it's largely on demand. Even on fundraise, it's largely on demand. I won't work with them in planning what matrices to hit, when to go for fundraise. They will come to me and largely say that, look, we feel we are ready. What are the 5-10 people you really know well and can write an introduction?
Got it.
And because even in industry, in many cases, you send their resumes to the funds where they are in it. So I can request them to give them a meeting. Right. And but it's largely very, very on demand basis. It's not a checkpoint driven. Sometimes I would not meet them for 2 years, but again, sometimes I would meet them 3 times in a quarter if there is an ongoing challenge going on. But it's usually very on demand for founder angels.
Got it.
I want to take up Arvind Sethi's question. What happens if my business is in a sort of offbeat space? His specific business is a wearable, but it could be another deep tech business. It could be a hardware business for which the number of options are often limited. Do you see enough angel demand for some of these offbeat businesses that are not quick commerce and D2C and fintech and so on? And what would you recommend? How would you recommend a founder like that to go about his first fundraise?
I think no business is offbeat anymore. I think it's changed in last 5 years post-COVID. Especially deep tech, the view on deep techs has evolved. Market understands it more better today. Wearable also, thanks to ultra human success, has come in the consciousness of people. In fact, most of us are very wary of next quick commerce business, right? So offbeat businesses don't have the similar challenges that they had in fundraising a few years back, right? But I think the other issue is who are the right people for such businesses to fund and support, right? So other than the money, you also need specific expertise in these businesses more often than not, which is probably not even available in angel community, right? So it could be either the founders of similar businesses, if you're doing something in space tech, right? Or maybe drone tech or something, or biotech, which I always encourage young founders to bring 2-3 founders either as angel or advisors onto their equation, right? And I think that's a good one, because those founders are 2-3 years ahead in journey. They have seen the space, understood various different dimensions of that market. So it really helps there in the functional expertise of the domain-specific expertise. But many things in building the companies remain the same, right? Next fundraise has to be done. People have to be hired. Doors have to be opened. That is generic across at least B2B startups and GTM for B2C startups. So deep tech will be more B2B kind of driven businesses, mostly less. So you need both expertise with you. I hope I've answered in a way.
Actually, maybe
It's
I'll
not
add
as
one.
onerous to raise a fund for offbeat or deep tech as it was 3 years back.
I'll maybe add a quick thing. All successful companies that look in the trend today, they were all offbeat at that time. Delivery took forever to raise their first round. They had to dilute like 35% of the company for first 6 crores. Flipkart again struggled a lot initial 1 year to raise money. I'm sure when what you guys invested in WhatFix, it was not a trend business. It was an offbeat business at that time, which became in trend when they become large.
Even
So
Mama,
Mamaearth was not an. Actually, I asked Rahul once, why are you backing this company? Because D2C was not hot, right? Because D2C
Abhishek, we
companies,
also asked
brands
for
were.
the record.
So brands were really actually for both Mamaearth and Zook. I spoke to Rahul once. Ki, aapka kya thesis hai? You tell me once, because I was also learning that why are people backing brands, because brands have historically struggled for 20 years, and then suddenly something changed,
Right.
and it started to scale well. So everything which looks trendy and cool today were actually very offbeat at that time. Meesho is a similar example. These were impossible to fund companies at that stage. So, and all these founders, many of them I have known personally, they've all said that, look, is my own company the only ugly company in the town, because everybody else is getting funded and I struggle to raise every round. So I don't think you should get disappointed if you feel today your business is offbeat, because every good business that looks cool today was offbeat at that stage.
well said.
Yeah, no, very true. Very true. I want to pick up on a point, Abhishek, again, you had mentioned, and I want to go slightly deeper into it, which is that sometimes there are people who are putting in money in your company as an angel, which is fine. That's a great news, and you leverage them as well. There are times when some people actually do not want to put money, but actually want to be advisors. And then people give them advisor equity. I've, by the way, sometimes seen a combination of the two as well, that you are an angel with an angel equity, and on top of it, you have an advisor equity, right? Even though you referred to it, Abhishek, and this is a question for both of you, right? do you recommend people to push advisors also to be angel investors? Or is it okay to have a mixture of angels and advisors? What would you recommend people?
So I usually figure out if I was starting a business today and if it's an industry where I really need help. So for example, if I'm building a product for healthcare SaaS US, I have absolutely no network today. So first few months, I will try to get somebody who is an angel, but also comes from that market who can potentially help me. But if
Yeah.
I don't get somebody, I will be open to giving advisory equity. But I would first try to make sure that I get 4 or 5 angels from that market who I can then connect regularly and take input. That's how I would approach it. Getting these people at a later stage of company is easier. Once you raise Series A, and then if you are getting these people as an angel, you can actually get them to put money and you can request them for time fairly regularly. And they don't mind that. That I've seen personally. But I think if you can't find it, then be open to giving some advisory equity because there are markets where you need access, where you need introductions in initial days, and it's okay to give advisory at that stage.
Right.
Yeah, I have seen some people giving 15, 20, 30% advisory. That is nonsense, right?
Yeah.
So I have said that try to limit your advisory, value your equity. Keep it to maximum 5% in between 2, 3 people, preferably, right? So when I look at companies pitching and they've already given 10%, 15% advisory equity to someone who meets them once a month or once a week for an hour, that doesn't send good signals to me.
Correct.
So the thing is, ideally, who do we want to fund? We want to fund a company or its founder who never needs us again, right? That's a dream company, right? So if you have too many advisors and too much equity you're giving, it sends a signal to me you're not figured out your act, right? You're still in sort of thinking through stage and experimental stage. So my two bits would be advisors, yes, in reasonable proportions, very pointed, very specific, and value your equity.
No, that would be. I would 200% agree with that. I have seen it a few times. A lot of people actually approach me and say, "Okay, we will give you 2% equity if you help us raise money." I mean, that is a clear no-no because that's not how that's not what buyers are looking at. Buyers are looking at founders who have figured out their thing. They know the industry, they know execution. Maybe for market access, once in a while, you can give 0.5%, 1% equity. But if you are throwing equity for every valuable work to be done in the company, that's usually going to send a very poor signal.
I have one question for the both of you. When you evaluate a company for angel investment, what are some of the turn-offs for you? What would make you decline pretty much immediately during a pitch?
I have learned to listen. Oh, you see, it's like this is the exact bias we have to remove. If I may so, sometimes irritating persons can create great companies, right? So what we try to do as a discipline कि पहले 20 मिनट हम सुनते हैं सिर्फ, right? हम बोलते नहीं हैं when person is pitching because whichever way he's pitching, sometimes he's obsessing with his idea, sometimes he's obsessing with his career and past, what he's done. Sometimes he's too much of product centric, sometimes so you want to see everything in a pitch, perfect pitch, but there is hardly ever a perfect pitch, right? So what we are training ourselves is to एक बार 20 मिनट अच्छी तरह से सुनते हैं without any bias, without any judgment on his facial features or expressions or whatever. So this is what I am trying, and ये बहुत मुश्किल है. Human biases creep in very, very early on. Some just founders just are so charming and लगता है अभी पैसा लगा दो, but it's not that they actually execute well. But on a sort of a preference scale, I want to see evidence of execution in whatever you've done in life, right? Even if you picking up a new idea of which no one has thought about it, you think is the most revolutionary idea in the world, I still want to understand you are the right person to solve for that, right? And I find people spend less time in the pitch on that. They spend more time on the idea, how that idea will change the world. That is less important to me. Whether it's, if that idea is to work, are you the right guy, right? So a little bit more time on that in your deck would help me to make a better informed decision.
Correct. This is a very interesting question. I will also wanted to chip in. So obviously, I feel that market is what has eventually made most impact for me in the story. I have to put in a lot of effort to ignore the negatives in the founders. Most founders have a lot of things that you will notice in the meeting, and you will feel that maybe this is the reason this person can't do it. And but I feel that ignoring a lot of shortcomings of founders has been a big superpower. Including things like past work experience, negative reviews from past work. A lot of my successful founders all had negative reviews from their past bosses. And one thing that really turns me off eventually is that if I feel that the founder is not ready to spend time on the idea. A lot of time I meet, they say, look, in 5 years, I want to sell and I want to retire. So that is a clear turn off for me. I want to back founders who want to build the company for next 30 years, not even 5-10 years. Funds will stay for 10 years, but I think great companies get built when Narayan Murthy spends 30 years at Infosys or Jeff Bezos spends 30 years at Amazon. Apple launched iPhone in its 31st year. Just imagine, you are 31-year-old as a company and you launched iPhone and Steve Jobs is still at the helm. And nothing else you did in the past matters. So I want to back people who are ready to dedicate or sacrifice their entire life to the idea. There are again trick questions to figure that out, but I think for me it's a bit turn off if founder says that, look, I want to retire soon. I want to build, quickly sell it for 100, 200 crores, and I want to take 50 crores cash home and then retire. That is not the kind of founder I want to back.
Maybe one follow-up, which actually a couple of people have asked. Varun Jain has asked, and Nilesh Belore has asked as well. As angel investors, do you look for traction in the company before putting in your angel check? Or that doesn't matter to you guys? And if you need traction, the question is that to get to traction, we need money. Then where do we get that money from? It becomes a bit of a chicken and egg kind of a issue. So is any traction important for you at the time of investing?
Maybe I could. But before I answer that, I want to add to Abhishek's last point.
Sure.
I think you want to see evidence of authenticity in the founder, authenticity to the problem he's solving, right? It's like, that's what I think. We cannot predict whether he'll remain 30 years, 20 years, 10 years, 2 years.
Yeah.
We cannot. But there is a passionate pitch, but behind the pitch, the authenticity. Where is he coming from to solve this problem? I think that is an indication to how hard and he'll fight for that problem, right? Because there'll be every 3-6 months, there'll be points where they can give up, right? We've seen it. So that's what I wanted to add to Abhishek's wonderful point. Traction, yes. So sometimes we fund people with ideas only. But that again, typically you would do with people who have some kind of track record, right? Some kind of indication in their past that they can build it, right? You can biased on that. Yeah. Sometimes you feel ये idea अच्छा है, team भी शायद ठीक है, but market may reject it or not reject it. So you assess, maybe we can come in the next round. I do it very often. I tell them, look, here we could give you 1 to 2 crores. I like you. I like what you're solving for, but we are not ready as yet to back you. But 6 महीने में definitely मिलेंगे. And I actually am investing in a lot of such companies. So उस समय maybe you're paying a little bit more. So instead of 5 million valuation, the company has come to 10. unless I don't think in that short period company becomes a rocket ship that you cannot get on to the next round. So you don't end your meeting with them, no, we're not funding you, right? Or sorry, you didn't pass through our IC. You have to have a politer conversation and give proper feedback. Why I couldn't make that decision now, but I remain interested in you for this reason. And I think founders appreciate that. I think they like someone who gives them genuine feedback. And why genuinely I couldn't do it, but I am interested in you. I want to see you building a little bit on it. Your idea is good, but show me a little traction. Sometimes it is B2B company, show me 5 customers, show me 50K ARR. Sometimes it's also D2C where some product is not complete. So that's how I have altered my thinking to have that conversation if I am not investing at that point of time because of lack of traction, right? Having said that, what is traction? Traction is an early evidence of product getting accepted in the market, right? It's not PMF as yet. So we don't invest at all. Probably you guys do at some larger evidence of PMF. But I'm sure Abhishek and me invest when PMF to bahut dur hai abhi, right? So it's some indication of customer love, right? So that's what I want to see through that. 5 customer bhi kafi hain, 2 bhi kafi hain jo love dikha dein, right? And if there is a D2C business, I want to see little bit of repeat, right? Not massive repeats, but evidence that repeat is there. And how founders are focused on that for solving for that problem, right? These are some of the things I've learned.
So if you're pre-launch, I think if it's pre-launch, you have raised your bar of financing to maybe 10x at least. If there is something to show, it shows that you're committed to the idea, you have done some groundwork. But there are businesses which you can't bootstrap with your personal money or with some friends, and like first round is friends and family, right? So if you can't do some prototype at 20, 30 lakh, then maybe you have to wait it out. So in those cases, at least I would want some validation on the market, some validation on customer side. So you will need to do a lot of that groundwork to make sure that a very compelling story that this is really a very large market and there is a clear gap. So that much you have to establish. The gap is real. The customers, there should be some customers you have spoken to are willing to buy, get some LOIs if needed. But you have to do a little bit of work on validation of customer and market before things starts to move for you.
Actually, that's a very important point, Abhishek, even though we are asking the questions, but I will add that. So Rajesh, today, by the way, 60% of our checks are also at inception stage. Get no revenue, no product also, right?
Yeah.
And what we look for at that stage, of course, we want to look at what the founders have done in the past, etc. But we also look for evidence of any insights that they are generating on the market basis the research they have done. I think sometimes it's damaging that you just thought of the idea 2 weeks back, jump into the market, start raising.
Right.
You haven't, I mean, I'm a B2B guy, so I want people to have talked to 50 prospective customers, right? What are they saying? What insights have you generated in the process? And you may have no product, no traction. That's okay. But do you have insights or not on the customer? That does matter at the time you are sort of going and raising funding. Sorry, Ritesh, you were saying something as well, so please go ahead.
No, I was actually going to ask another question, which seems very interesting, and I have never thought of this, which comes actually from an anonymous attendee here, which is that people that most believe in their idea might have the money, but they are not habitual angel investors. They have never written an angel check before. These might be people that are believers. These might be people that know them well from their past jobs. So would you recommend spending time with people who have never written an angel check before? Like, is it worth pitching to someone to be their first angel check ever?
Yeah, tough hurdle. From person who's not ever invested, getting money from him is tougher task from people who invested. Generally, right? Look, a founder will make 100 pitches while investing. There's no harm if you like the guy and he is adding value to your business, you determined that one more pitch won't do any harm to you, right? In fact, you will become better after his questions because he's coming from new lenses. He doesn't have the lens of an seasoned danger, right? So there's no harm. If I think you should pitch, and so look, at that point of time, I'm thinking you're gonna make a lot of pitches, right? Right. Even at Series A, people make how many pitches, right? 30, 40, 50, many, and even there one works, right? So you don't know which one will work, right? So I would advocate but prioritize 80%, 90% of the effort on people who are already used to investing, but do invest to new people. Do pitch to new people.
If I may chime in with a question from my side here, and this was prompted by one of Rajesh's comments earlier, where, Rajesh, you were saying that, look, one could maybe, let's say, have a 5 million valuation at which you're coming in now, or you can come in the next stage at which it might be 10 or 15 or whatever it might be. Sometimes I have also heard that, let's say, you are going and talking to angels, and there might be a certain valuation that they are comfortable with, but founders will talk to 5 angels, put those 5 faces on their pitch deck saying that these people are already committed to me, and they're now pitching to a VC simultaneously as well. And the VC says, fine, I'll also come in. I'm going to put in $2 million in this round as well. And guess what? The moment the VC decides to put 2 million, the valuation becomes 10, 12, 13, 14 immediately. The stage has not changed. But now, from a founder perspective, I think at least I can imagine that they're treating it as a stepping stone. They talk to you, use your credibility to go and pitch to VCs. How do you think of that as an angel? Do you discourage founders to raise VC money in the same round as they're raising an angel round? Or it doesn't matter to you?
So actually, in my case, I would always prefer that in the round, you at least have one person who can handhold you properly. Some professional investors there that really changes the trajectory of the company. And that's why I said there are 3, in my head, there are already 3 steps in the same round. You go to your people around you, get some validation, use that validation to talk to professional investors who you may not know. If you already know them, then you go in step 1. Right? If you have a lot of friends who can write to investors, their portfolio of these funds, then you straight away go to them. But otherwise, you say, these are seasoned industry people, they have already committed. Then they find a lead. And then after the lead is found, then you also go outside the 2nd degree, 3rd degree people who don't know, who actually come from that industry and can add serious value professionally. So this is the cycle that you will do. And if the price increases, but you get a credible investor, the risk cycle also decreases a lot. So in my head, like angel, the probability of success of a company at an angel round and a VC round is significantly different. Even if the price goes by 4x, in my opinion, the probability of success goes up by 10x. So whenever I commit, I would always write to like 50 VCs and say, come along with me. So that is my preferred model. If I get a company in my 1st degree or somebody and I really like the company, I would always write to a lot of people and then make sure there is a good seasoned investor who can work with them on a monthly basis and take them home. And it's a tough journey. So it's good to have people who have seen this journey over and over and over again.
Abhishek, before you write to other people, please write to us. So we'll log in that.
Let me add a couple of points to this. So in our case, we also give term sheets where we're leading the round.
That's right.
So I think it's unethical then to shop around after that. Once you accepted my term sheet, then let's execute, at least for that point.
Yeah.
The other thing is, if you're using some people's soft commitment in your deck, right? Sometimes people say, "Aap lead le aao, to hum kar denge." Then don't unethically represent it. Then that means these people will come at whatever valuation range you discussed. Obviously, valuations will change if it's just an angel round to a VC round, because VCs also need 10-20%. You don't want to dilute the founders for that money. So one has to be practical about it. And I maintain probability of success remains the same. Whether VC comes or angel round comes, it doesn't change. Finally, the only success is guaranteed by the founder and how he executes in 3-6 months. Having 1 or 2 extra millions in his bank doesn't change the game. But for a few company models like quick commerce. So that's my
That's humbling as a VC, Rajesh. आने आना आने से कोई फर्क नहीं पड़ता.
नहीं देखो उतने angels, lot of only a handful of angels make money, to be honest.
Yeah.
And then it's also correct that handful of VCs make money, right?
Correct.
तो
So
हम
मुझे ऐसा लगता है
game में
discipline helps. But also advice may not, like advice can be debatable, but just having a discipline of somebody you report to every 2 weeks, every month,
yeah, but many
saying
VCs
कि ये हुआ
and
है.
two things, all partners are not the same in a VC firm,
Of course.
and all VCs are not same. Some
बिल्कुल.
firms have destructive habits, which can
So
be
I would agree with
illegal.
that. Broadly speaking, the advice is debatable, but the discipline, I felt that just having that like even if you go and talk to somebody who is not responding back, but you preparing yourself saying that ये मैंने क्या किया है, what is the next one we are planning to do, that just thinking actually somewhat helps, in my opinion, to prepare as a company.
Yeah.
And
No, I mean, I'm obviously highly biased, but I would even say that the capital available for the next round also makes a massive difference. Because every company hits roadblocks, every company hits bumps on the road. And sometimes you need those deep pockets that only a VC can bring to ride through some of those hard times.
Point taken, but also sometimes when you are pre-PMF, companies need to change, pivot. Those experiments should be done at the lowest cost possible, because then your cap table is, I have actually 10 such companies in front of them, and 3 I'm advising, where they get into irretrievable bad situations if the backup doesn't come. And trust me, Ritesh, in most cases, backup doesn't come when it's needed. Right?
Yeah.
I don't want to be judgmental on that, but
fair point.
No, very, very fair. We've all seen those cap tables where the company is a fresh pivot and investors own 60% of the company.
Yeah, so we want to avoid that. So that's the point I was making.
Fair. I have one last question from my side, which is, how do you think about exiting relatively early in these companies? Very often, angels do need to sort of make space for larger incoming investors. And, on the one hand, I'm sure it can be a heartburn that someone is coming in expecting a 10x, 20x from here. And the angel is having to sort of forego that upside. On the other hand, it's a little bit more of a sure exit compared to waiting for an eventual trade sale or IPO. So would love to hear your individual thoughts on exiting in, let's say, Series B or so, when in order to make space for newer investors.
So I am fairly clear that I practically never sell. I only sell when I really need the money to do something. So whenever companies come and say we need exit for the round to make happen, I usually politely decline. I always tell them, look, these guys will stay for 8 years. I will stay for 30 years. So I am still going to be there when they are gone. Right. Again, Apple is a great example. Apple is almost like 50-year-old company. The Sequoia stayed on the capital for like 6 to 10 years. So it is like K-12 for them. Right. So I will continue to be there, work with the founders, they discuss with them whenever they need. I believe that if I invest in 1,000 companies, I will be lucky enough to hit one Apple or one Facebook or one Coinbase, right? So I just want to stay on and see that happen in front of me. So that is my dream. That's why I keep sitting on the capitals for a very long time. Even in delivery, I've sold quite a few, but I still own some stock in the company even now after 13, 14 years.
I think same thing. I communicate very clearly upfront that we are lifetime, right? Don't force us into exit situations, especially early on, right? For managing your next round, where you want to do a blended sale of. So sometimes founders are in tough situations where they're struggling to get the valuations they want to get. They want to get some secondary bundled into the primary raise. So that is one situation I've encountered. And sometimes we support it. And also sometimes I think there is another angle, and I think we spoke about it. It's like sometimes market value the companies excessively. We saw that, right? And in hindsight, I think we should take some money off the table, if not full. It just happens in our business, right? Ordinary companies get valued extraordinarily, and great companies don't get any value. Both things happen in different time spans. So as an investor, you have to recognize and be like, I remember when we had Slintel, you guys took more exit than I took. In fact, founder took more exit. He took 50% exit. I took only 25% exit. Right? That was a very exceptional. And after 3 months, I was feeling, hey, इन्होंने क्या कर दिया? The Sixth Sense raised another round. My money doubled. But after 3 years, we are back to 0-1, right? Same game. So the learning here is that जब at some hyper situations, exercise investor hat, if not fully, partly. That's my learning.
Great. Guys, we do realize that we are actually now beyond the time. We do promise that we'll start on time, end on time. So we'll keep that last question as the last question. But Rajesh, Abhishek, thank you so much for joining us today, sharing your experiences, your wisdom with all the founders. And until the next SaaS Talks, when we expect to see all of you again, thank you so much.